Thank you for joining us on our call today. Pleased to be joined by Michael Hughes. He is the Senior VP and Portfolio Manager at BMO Global Asset Management, along with Hamish Lillico, Senior Associates. They're here today to talk about the BMO Concentrated Global Equity Fund. This is a core fund and all of our income growth and fund-to-fund mandates. So if you're in those, you own this fund. They've delivered exceptional returns the last couple of years, including this far in 2020. And to talk a little about the fund and to do a bit of an introduction, I'll pass it over to Hamish. Hamish.
Thank you, Sean. Yes, joining us today is Michael Hughes, who is, as Sean mentioned, is the Senior Vice President and Client Portfolio Manager for Guardcap Capital. He's been with the team since 2014, and we've been fortunate to have this fund since, for 2 years now, so since May of 2018. Michael's experience, he's been with Trinity Street Asset Management and also as a Managing Director at JP Morgan Asset Management, where he was responsible for product management of over $72 billion of European equity funds. He's joining us today from London, England, so it's a pleasure to have him here, and he's obviously in a different time zone to us all. But Michael, would you please go ahead and take us through the fund, and at the end I'll give us a little recap on some of the options we have available within our mandate.
Sure. Thanks, Hamish, and thanks very much indeed, Sean, for giving me the opportunity to talk to you today. What we thought we'd do is I've got a presentation here. I can show you a few pictures which might make explaining things a little bit easier, but don't worry, I'm not going to drag you all through one of these interminable presentations. And of course, I hope we'll leave some time for questions. So the idea is I'll try and speak for maybe 20 minutes max and see if we can get through in that time. One picture I want to show you is just something which shows you a little bit more about, who I am and who we are. As you can see, really, I represent this middle part that you see here. And maybe you don't see it quite yet. It takes a little bit of time to come up. I'll just wait for it to pop up, I hope, on your screens. Can you see it yet?
Yeah, I can see it there, Michael.
Okay, great. So hopefully you can see a picture here. So we are a company, actually. We're just 19 people. We all sit in one room, in fact, in an office in central London, just near Piccadilly Circus, for those of you who know it. We have a team of 4 running this global equity strategy we want to tell you about today, another team of 4 doing an emerging market variant, and then myself and my colleagues who look after our clients, another team looking after compliance and all that. But as you can see from this picture, there's a bit more to it. We are actually part of Guardcap Capital, which is a Canadian company which has existed since the 1960s, quoted on the Toronto Stock Exchange since 1969. And Guardcap Capital brings 2 really good things to a small company like us. One is a huge balance sheet, very, very financially strong business, which means that's effectively we are too. And then also lots of additional resources, more people to help us with the sort of day-to-day of what we do. The team that manages this strategy is small. It's only 4 people. But the way this strategy works, it's basically 20 to 25 companies. It has turnover of maybe 10% a year. So in a busy year, we need 2, maybe even 3 companies to keep this strategy working, and I'll explain why that is in a minute. And so that means that we don't look at a lot of companies. What we do look at, we look at very, very deeply. This team is comprised actually of somebody in their 50s, 40s, late 30s, early 30s. So you can see it's 2 men, 2 women. They have different backgrounds, education, qualifications, experience, nationalities, and so on. And basically, they work as a team of 4 on every single company. And the beauty of that is that if you leave the whole decision making about a company to one so-called specialist, then you're subject to the fact that they hear information slightly differently from each other. They might have biases, prejudices, simply not enough information, and that can lead to bad decisions being made. In this company, in our firm, the company that we're thinking of investing in has got to satisfy, the CFA, the MBA, the millennial, the woman, the former ESG specialist, the former global healthcare analyst, and 2 guys at the top there have actually worked together on this strategy already for 23 years continually. And if the company satisfies all of them and keeps satisfying them, there's a good chance it's going to work out all right. So making good decisions is a key part of making a strategy like this work, but we think we have a good team to do that. The team is big enough to do the job, but small enough to genuinely collaborate on the companies. As you can see, we do away with hierarchies. Everyone does the same thing. We encourage everyone to speak up, to work together and collaborate effectively. Now, essentially, how and why does this process work? Okay. When you set out to beat the markets by a lot, and that's what we're trying to do, okay, you are taking on something called efficient market theory, okay, which says that the markets are just going to do a better job than you. The markets very efficiently process all and any information there is about a company, and then they attribute value to that company in real time. And that's true. That is absolutely true. There's no way that us sitting in our little office in central London, we're going to get more information or quicker information or necessarily better information than everybody else. So why is it that we think we can continue to beat the market over a long-term time period? And this is the fundamental reason. If I explain one thing to you today, that's this, and then you will understand fundamentally how this works. The information that the market so efficiently processes is basically short-term in nature. It's about the here and now. It's about what's to come in the next year or two. If you think about it, it's just the guidance that's given to you by the company or given to the market by the company as to what to expect from its earnings this year and next year. Then brokers write reports with forecasts on companies with a 2-year time horizon. And then fund managers come along and they invest in companies, well, on average for about 18 months at a time. So the whole market revolves around an information set that's basically very short term in its nature. And this gives rise to one last opportunity to beat the market sustainably, which is this, that if you find a company, let's say it's growing its earnings at 12% a year, okay, that will be valued by the market at a premium to the market. It might look expensive in a PE sense, but if in talking to that company and analyzing it and really getting to know it, you can build conviction. It's not only going to grow its earnings 12% this year and next year, but it's still going to be doing that in 5 years' time and maybe even 10 years' time, then there's a very good chance that the rest of the market, which remember, doesn't really look beyond its own nose very much, is going to underestimate the company's ability to do that because it's only really thinking about the next couple of years. So everything that we do in our firm is about the long-term thinking, long-term forecasting, and then we hold on to these companies for a really long time because only by doing that can we exploit the short-termism that pervades everything that happens in the markets. So what we do is we look for markers of this sustained long-term growth. If you look at the two things in blue on the left-hand side here, there are two keys to finding these companies that are going to grow beyond the time horizon that the market really thinks about. First thing is the company must be in an industry that itself is in a state of long-term, what we call secular growth. It doesn't really depend on what's happening in the economy as a whole. It just grows under its own steam. And then the second thing with that is that we look for a company which is in one of these great industries, but it's got to have some way it can keep that competition out. Otherwise, you risk that the industry grows and your company doesn't. So some kind of sustainable competitive advantage. Maybe that's a great brand. Maybe that's a great widget that it's created through years of research and development that no one can really compete with. Maybe it's just lucky, like Moody's is in this portfolio. Moody's rates companies' debt and other issuers' debt. And if you want to get your debt rated, you can't just go to your friendly debt rating company down the road, because if you get a rating from them, it won't help you sell your debt. It has to come from what is really a duopoly of providers like Moody's and Standard & Poor's. So sustainable competitive advantage, even if they don't really deserve it. Over on the right-hand side as well, another thing to remember about this portfolio is that quality underpins everything that we do, okay? So the companies must be of the highest quality, because if they are, that will give you some downside protection. So there's no debt if the business is strong and stable, has been around for a long time, and also if it's got the highest standards of ESG, environmental, social, and governance, which we call foundations for sustainable growth, then this will help with downside protection. Now, going back to the secular growth trend, this is one of the companies that we've invested in, okay? It's an American company called Automatic Data Processing. This is a 50-year chart of it, no less. The green line that you see here is the earnings per share, and the blue line is the stock price. You can see clearly there's a relationship between one thing and the other. And in fact, what the little numbers in the top left-hand corner are telling you, and I'm sorry they're not very clear, is that over 50 years, this company has grown its earnings compound by 13% a year, and the stock has gone up 12% a year for 50 years, which means this has been an extremely good investment over a very long period of time. Just think, if your investments have been winning 13% a year over that long, they would have done extremely well. Now, what did we do with this company? Well, we invested in it for the first time in 1999, and it's still in the portfolio today. So we believe that by creating a portfolio of companies like this, which will generate long-term double-digit earnings per share growth, then our strategy can generate long-term double-digit returns for our clients. And that's what we set out to do. Note also that the gray areas that you see here with the circles around them, they're bad times in the market. The last one there is 2008 to 9. And as you can see from the green line here, the company's been able to continue to grow its earnings during that difficult period, which means that the stock price is not great, but it's held up okay in what was a very difficult environment. What this company does is it provides outsourced human resources services to companies. When companies get big and complicated and more international, the job of hiring people, keeping them, paying them, taxing them, and getting all that absolutely right and up to the minute is difficult. If you try and do it in-house, you'll end up with a big human resources department. That'll cost you a lot of money. So instead, companies have a trend towards outsourcing it to companies like ADP, this company, which is the leader in both the US and in Europe in the provision of these services. And so there's been an ongoing trend to outsourcing of this on this basis, which has meant that the company's been able to hold up well, even if the markets are difficult. And that's the kind of thing that we look for. And then, as this chart shows, there's a whole lot of things we don't do. So this is a bank. In fact, this is JP Morgan, by no means the craziest bank out there. But you can just see that in the gray areas, it's not a good place to be, because banks are sensitive to what happens in the economy. Note how at the very end, it's already beginning to take a bit of a plunge. And so for that reason, this strategy has never, in all the 23 years that it's existed, ever held a bank of any kind. It's also never held a mining company or an oil company or anything in steel, chemicals, autos, airlines, anything that is sensitive to what happens in the overall economy. And the reason for that is because when the economy takes a dive, as it does periodically, and of course, as it just has done, it tends to be those kinds of companies that get hit the most. And guess what? With the COVID crisis, the companies that have felt it among the worst have been airlines, oil companies, raw materials, and so on. And you've just never had these in this portfolio. And that gets you off to a good start in terms of your performance relative to the market when the market is having a difficult time. It also means, of course, that if you do have Canadian equities in your portfolio, that this portfolio is very different. It's a diversification. It brings something different to your portfolio. And so it has a genuine benefit as a diversification in the equities that you might be holding overall. Now, the way we go about it, I'm not going to go into a whole lot of process stuff, is we kind of start at the bottom here, we go deeper and deeper and deeper into the company, and in doing so, we build conviction that the company really does meet all those criteria we were talking about. By the time we've finished our analysis on a company, it'll take about a year. We do a huge amount of work on these companies. And yes, we're looking at household names that everybody's looking at, but we're looking at one thing that's very different from everybody else, which is what's going to be happening in 5 years' time and beyond. Not so much what's going to happen this year. We're not thinking about how fast is the company growing now and how much should we pay for that growth, because everybody's thinking about that. The market's onto that all the time. What we're thinking about is, will it still be growing at the same rate in 5 years' time? And that's a very different thing. And that's essentially how we add value. This picture that you see here, that's Giles on the right and Boyana from our team on the left. They're about to jump into one of those white trucks with Myron and his colleague who worked for the Orkin Pest Control Company, which is part of the Rollins Group. They're in Atlanta, Georgia, and they spent the morning doing a ride around with Myron and his colleague, visiting restaurants and houses and kind of zapping bugs for the morning to get to understand this company more closely. That's how deep we go into these companies. Now, there's one other aspect of this that's really important to remember, which is that if you really want to understand the long-term future of a company, and we do, it's not enough these days to understand the future of the company, because the future itself is changing very fast. And so we have a whole different thing that we do alongside this really in-depth analysis into companies, which we call DORA days. So DORA stands for Day Out Researching Anything. And on a door a day, our teams go out of the office, they go and do something different, fun in the morning, team building. And then in the afternoon, they sit down and talk about papers, which look a bit like this. And we can see some examples on the right-hand side there, which are about secular trends of the future. And we've been doing this since February 2015. And as a result, we now have 76 papers of this kind, which taken together represent a kind of library of the future. A library of the future of the commercial world, if you like, so that when we are thinking about companies to invest in, and when we're thinking about the companies we've already invested in, then we can think about all of these things and whether they represent a threat to the companies that we've already invested in. Now, this slightly strange picture, this was from one of the papers called The Changing Relevance of Brands in the Modern Era, okay? And a lot of the paper was taken up with the story of this company, which was the plaything, if you like, of George Clooney, whom you see there on the left, Rand Gerber on the right. He's Cindy Crawford's husband. They're riding around on cool motorbikes with no helmets, looking cool, and they're promoting their Casamigos tequila brand. And in fact, Casamigos did so well that it began to eat into the market share of Jose Cuervo, the provider of the top tequila brand in terms of market share, to an extent that really scared Jose Cuervo's owner, Beckley. Eventually, the company was bought by Diageo for over $1 billion. And so George Clooney got that little bit richer, which is always good. What the paper was talking about, however, was the fact that old branded consumer goods companies that have built up their brands over many years of advertising, on the side of the bus, the billboard, the newspaper, the TV, can be competed with now by new brands emerging very quickly, driven by social media, celebrity endorsements, influencers, that kind of thing. And so the branded consumer goods companies, brands used to be seen as the ultimate defender of market share, the thing that would keep the competition out. You think toothpaste, you think Colgate, or whatever it is. But now it seems that brands are not quite the same protection that they used to be against competition. And that's one of the things we've got to take into account as we do invest in those branded consumer goods companies. So finally, what kind of companies do we end up with in the portfolio? The key to understanding them is really to look, as it says on the sort of two right-hand columns here, what is the secular growth driver of this company? What is the sustainable competitive advantage? The biggest position in this portfolio is MasterCard, which you actually see second on the list there. What's going to drive MasterCard to continue to grow for many years to come? Well, it's quite simply the fact that last year, still more than 80% of all the payments made around the world were still paid for by cash. And I know Canadians have a hard time believing this because actually Canada is much more advanced down the road to digitization of payments. However, many countries are not. In the UK last year, for example, payments by debit card exceeded payments by cash for the first time. And when it comes to sustainable competitive advantage, well, MasterCard and Visa, they were the bank's payment network until they were spun out as independent companies in the mid-2000s. We first invested in MasterCard in 2009, and it's still in the portfolio to this day. So secular growth, sustainable competitive advantage. Perhaps one more example, Yum China that you see there. Yum China basically does KFC, Taco Bell, Pizza Hut, but just in China. Okay, it was spun out of the Yum Brands group, which owns those brands. Now, why is this interesting? Because in China, there are 7 of those restaurants per 1 million inhabitants. In the US, there are 57 of these restaurants per 1 million inhabitants. In Malaysia, there are 31. So you can see the growth potential in China. And the other key part of this is that in China, there are 15 million new urbanites every year, people moving out of the countryside and into the city. So you can see the prospects for Yum China to grow many years into the future are absolutely clear. And is Yum China, has it got defensive abilities? Yes, it's the leader in logistics. It's the leader in systems in that market. It has a loyalty scheme with over 300 million members already. And it's been described, as you see there, a leader in logistics and systems, which happens to sell fried chicken. So it's really the best at what it does in that country. So secular growth, sustainable competitive advantage. Then finally, perhaps let's look at this bit. This is looking at the returns on the far right-hand side here. This is what this strategy has done since we set up our company in July 2014. In Canadian dollar terms, this has generated 19% a year, whereas the index that we compare ourselves with normally has done 10% a year. And so that's nearly 9% a year better than the index has done. Note how also over on the left-hand side here, obviously it's been a very difficult year in the markets so far, but that's what the strategy has done because of that downside protection. And that's what the index has done, plus 6.9 against minus 2.1. If the year were to end that way, that would be the latest in a long string of years during which the markets have gone down, but this strategy has gone up because of the secular growth and the quality of the companies that we invest in. Now, in terms of the world of COVID and all that, is this the right kind of portfolio to navigate what comes next? You can group the companies really into 3 or 4 or maybe 5 groups, okay, just simplifying it greatly. Firstly, this approach that we have leads you to invest in really strong, sustainable, defensive kind of plays like Colgate, as it says here, and also Novo Nordisk, for example, which is a company which is the leading provider of treatments and solutions for people suffering from diabetes. And you would hope that the demand for those products would not go down in a difficult economic time. Okay? So those things held up really well in the tough times. Then you've got a bunch of financials, which are not banks, but they're basically stock exchanges. So stock exchanges love turmoil because if the markets get upended and everyone starts moving their portfolios around, guess what? The volumes going through the stock exchange go up and the price of the stock exchange itself, the stock exchange company itself, goes up rather than down. Moody's also has benefited from a rush to issue investment grade debt in an environment where interest rates are at an all-time low. Then you've got a number of digitization companies. So companies which are benefiting and leading the way in the transformation of economies towards the digital world. MasterCard is one example that we've just been talking about it. And if anything, you see, as a result of the COVID crisis, the digitization of the world has been given a shot in the arm. People have got more used to working from home, working on their computer, buying things on their computers. And so if anything, digitization is now going to be more advanced than it would have been had the COVID crisis not hit. Then the other major category in this portfolio are consumer, what we might call discretionary companies. Companies like Yum China we were talking about, Nike, L'Oreal, Essilor, which is a leading provider of spectacles and lenses. Those kind of companies have done pretty badly. They got pretty hard hit when the high streets were closed down, but they will recover. And we think that those will drive the returns of the portfolio as we emerge from the lockdown. So over the long term, I just want to show you one more figure. These two figures, upside and downside market capture that you see towards the bottom of this thing, what that number, 112%, is telling you is if you just take the up months since July 2014, what has our portfolio on average done in relation to the index during the up months? Well, on average, it's generated 112% of the index's return when the index is going up. As you can see, the number below is telling you that on average, when the index has been going down, it's generated 69% of the return of the index. So it's strongly outperformed when the markets are falling. And then it kind of keeps up or even does a little bit better than the market when it's rising. And it's this combination of companies, some of which are highly defensive, some of which get a little bit more hit by the economy, but will recover, that we think means that you've got a good portfolio to go through the next stage through. If the markets don't do well from here, well, you've got these strong defensive names that will hold up well. If things continue to improve and there aren't any more outbreaks of the virus and we don't have the second spike and all of that and economies do recover quickly, well, you've got the companies in this portfolio to deal with that as well. But over the long term, the reason why every single one of these companies is here is because we think they are the companies of the future. They will be doing well in 5 years' time. And that must be a good thing to build your portfolio around. So that's really what I had prepared in terms of the sort of presentation, if you like. I hope that's helpful in giving an overview of how this all works. And of course, if you have any questions on what I've been saying, please don't hesitate. Go ahead, Sean.
Yeah, perfect, Michael. That was excellent. Thank you for that. You talked about obviously investing for the long term. One of the biggest long-term secular trends that will be near here is this revolution of 5G, which is going to completely change the way we live our lives. Do you guys have any thoughts on that? And have you taken any sort of positions in the fund?
Yeah, funny enough, we had a Dora Day paper on 5G written in 2017. And very often what happens with the Dora Day papers is that you end up saying, well, look, this is a trend, this is clearly going to be of the future, but right now, we have a quick look around all the companies that might be involved in that, but right now, there are none of these companies that we particularly want to invest in, particularly when you're going through the investment phase around 5G. Setting up the whole 5G network is going to cost a lot of money, it's going to require a lot of capital, and you're not in the immediate term going to get a huge amount of return for it. That may change in future. But the beauty of 5G is that all those digitization type names that we were talking about there, and there are various different things in the portfolio that give you exposure to that, are going to benefit from the advent of 5G. So you don't have to invest directly in a technology supplier or a company that builds the infrastructure, because actually constructing things and setting up infrastructure is not the kind of thing that we normally go into. Kind of, we don't have any kind of heavy industry. We don't want capital intensive businesses. We want businesses that sit back, if you like, and generate the revenues out of that. But absolutely, 5G is going to change everything. It's going to make the whole digital world work better and attract more people to it. And if anything, speed up the rate of digitization. And as I say, you've got a number of companies in this portfolio that will benefit from that.
And there's a lot of talk about North American equities trading at these pretty lofty valuations. This, of course, is a global fund. Some of the global equity benchmarks haven't rallied nearly as far as the American counterparts. Where are you guys seeing more value right now? Is it in those European names?
Well, funny enough, you see, value means different things to different people. And a lot of people take as a proxy for valuation, things like PE ratios and those kinds of ratios, which all, of course, relate to short-term outlook. And in fact, if you think about what's really happened, you've had a large number of companies coming out and saying, well, we said we were going to make something like this amount of money in 2020. No, we don't have a clue, because we cannot predict what's going to happen in the global economy. And so things like PE ratios and all that really don't work anymore at the moment. They've gone to crazy numbers. You're going to see negative earnings from the overall market. And so, in terms of the short term, all these kind of valuation parameters that you've had in the past are not necessarily a very good guide. Remember, what we do is we think about everything with a 5-year time horizon. And so what we're saying to ourselves is, okay, given what has happened, does it mean that any of the companies in this portfolio are ultimately worth less now in a real sense than they were when we went into the COVID crisis? It's very easy to answer that question when it comes to the likes of the Nestle's and those ones that have held up very well. But for example, Booking.com is in this portfolio at the other end of the spectrum. Booking.com is in the eye of the storm. It's getting very beaten up in terms of its stock price. But Booking has one or two major advantages, one of which is a massive balance sheet. The other is the fact that its cost base is completely contractable with volume. So it's able to massively reduce its costs, kind of hibernate, if you like, until the storm is past, and then emerge. And the beauty of it is that because of that strong balance sheet, it will emerge stronger in relation to its competitors like Expedia, like Ctrip, like the other players in the market, because it's got this massive balance sheet strength. Expedia is having to tap debt markets, try and raise private equity. When the crisis comes in, it will not be able to spend so much on being top of mind and all of that. So in the long run, which in our view is what really matters and which guides us as to what is the right things to invest in, we actually think that the valuations of the companies in this portfolio are not so bad. They are still okay. What is a worry is that you've seen, in some cases, companies that are actually ultimately, take, for example, physical retailers, okay? They were, in some cases, at death's door before this even started. And then they've been forced to close their shops for a period of time with very little coming in the way of revenues, depending on how much online sales they have. And they're going to emerge from this crisis in an even worse state, in many cases, than they were before they went into it. And yet the stock prices of that kind of thing have gone shooting up as well. And so I think the answer to your question, sounds like hedging my bets, is that in some cases, you're right. Some things are very overvalued in the market. You've got to be very careful. You've got to be very selective about what you invest in. But in our view, other things are not. To summarize it, we see what some people call value companies or cheap companies as actually being the companies that in many cases are not going to survive. They're not going to be there in 5 years' time. And the COVID crisis has, we would argue, hastened the end of some of those kinds of companies. Whereas there are other companies, like, for example, the digitization companies I was talking about, MasterCard, let's say, MasterCard has not done particularly well in the crisis. Its stock hasn't held up very well. But on a 5-year view, you bet MasterCard is going to be there in the middle of it all as more and more people transition around the world to paying for things digitally. And as I said, actually, because of the COVID crisis, we would argue that the value of MasterCard has actually gone up in a real sense, while the market's telling you that it's got cheaper. So the market is a mixture of things. The market's moving around in great big moves at the moment. And frankly, in terms of the overall market, Sean, I think I would say that it's quite possible there could be a decline again at some point, because in many cases, there has been a kind of departure from reality, if you like. But in some cases, and we would like to think that these are the companies in this portfolio, which are the definite, winners over a 5-year time frame, then the stock prices may go down a little bit. But remember, this portfolio did very well compared to the rest of the market when the market was down. You saw this portfolio has been up year to date. And we see no reason why that wouldn't happen again if the markets were to fall. You can't predict these things. You can't be sure. But if the markets don't work out too well, we think it's much more likely to be those weaker companies that are not really of the future that are going to get hit the hardest if there's another sort of market shakeout to come.
Perfect. I was going to ask you about the bookings one, but you took that one from me.
Right.
Well, that's kind of all the questions I had, but maybe I'll throw it over to Hamish. This fund obviously comes in a variety of different offerings. Hamish, anything else our listeners should be aware of out there?
Thanks, Sean. Yes, so we've recently launched a hedged version of the fund. So at the moment, the current version of the fund you're using is unhedged. In other words, the currency is not controlled in any way. It's just free to float. So we've launched a version where you can eliminate the fluctuations in the Canadian dollar through time, and that just launched last week. We also have a US dollar version of the fund. And the other thing we launched at the start of this year is actually a balanced version of the fund. And that is also available as a US dollar and a hedged version as well. So we've actually got a number of offerings of the same fund. And it really comes down to how your clients perceive currency and risk at the same time. So those, of course, are all available to your clients, Sean, and we're happy if you want to speak to them about those different versions.
Yeah, perfect. Thanks, guys. We'll end it on that note. If anyone out there has questions for either Michael or Hamish or ourselves, please don't hesitate to reach out. And guys, thanks again for jumping on the call today, and well done on the performance here to date.
Thanks very much, Sean, and many thanks to you and to everybody for giving us the opportunity to speak to you about our strategy today. We hugely appreciate it. And do please come back if you have any questions. Thank you.
Thank you.